All right, let's go ahead and get the show on the road. We are recording this training and we'll try to distribute that out to everybody afterwards. To get things started, I'm going to turn the call over to Mike Miller, who's the president of Primerica Mortgage. Mike, I'll turn it over to you.
Wonderful. Thanks so much, Nate. Thank you to our wonderful field force members who are joining here, our leaders that are out there. Looks like we've got almost 450 of you and still climbing, participating in this call right before Memorial Day weekend. I'm sure that everyone had on their list perhaps beach balls, towels, maybe some hamburgers, and I'm sure that you were just thinking to yourself, if only I could have a mortgage training going into the weekend, it would just top everything off here. So we appreciate you taking what is very valuable time that we want to get you back to your families and your plans and friends and everything else that you have going on here. But there has been some important updates and changes from a compliance perspective at Quicken Loans. Quicken is constantly looking at their processes and trying to improve things for us and for all the partners that they serve. And they are interacting with regulators on a regular basis. And sometimes they get feedback that initiates a change in a process. And we thought that the change was important enough today for us to get on and to talk to you about what that change is. And I actually think this is going to be very beneficial for our business for a couple of reasons. I haven't told you really what it is. You've been seeing that when you're registering loans, and if you have a QM failure over the last week or so, you're getting splashed up hey, you're failing by QM, contact a QM expert. And we've known that was coming. We were advised of it. And now there's going to be some changes where once we've had this visibility, we're actually going to need to make sure that we're taking action to determine whether that loan is a lender paid loan or a borrower paid loan in the beginning. And we're not going to be able to really move that down the road. And so that's really important. That's an important change for us. It's a change that is going to be flowing throughout the industry. And so we want to talk about what that change is and how that's going to affect our process and help us to get really good on making our process even better. And there's some tools that we have trained on and tips over time that we've emphasized that I think are going to become more important. But the great news about this, I think from your perspective, when you have to flip today from a lender paid loan to a borrower paid loan, your loan has gotten into a suspense status perhaps, you have to go through a change in circumstance. It pauses the loan. You've got to get back, it's not really progressing. It's not necessarily a great client experience. I think with all of this happening up front now, we have so much better visibility. Quicken has invested a ton of money in trying to give us the visibility that we need to get this right from the very beginning. They've got the QM experts there. So I'm going to encourage everybody to really keep an open mind during this training. Understand the concepts that are being shared with you and the importance of them, because I think that we can get to a really great place that's actually going to help us close more loans and close them faster and have better experiences for you, where you're not having to get loans that have fallen into a ditch back out of the ditch and onto the road. So I think that's going to be critical. We've got experts on this phone call here with Nate Collette, our Chief Marketing Officer, Bob Van Acker, one of the executives at Quicken Loans, and Caroline, who you know so well, who does so much of our training and does a wonderful job for us. This is a dream team. They're going to help you through this. I'm going to be on this call as well to share some perspectives along the way, but we're in great hands today. We're going to be efficient about this and get you back to your weekend, as we said. So with that, I will turn some time now over to Nate to pick it back up.
All right, fantastic. Thanks so much, Mike. Appreciate you kicking us off today. And again, thank you to everybody for taking the time out of your day to join us before Memorial Day weekend. Our agenda today is we're going to give you a real brief update on how mortgage is going with Primerica. And then I'm going to turn some time over to Bob Van Acker, who's a division vice president at Primerica. Most of you have heard some trainings from him so that he can give us a rundown of some of the changes that are happening at Rocket Pro TPO. And then we're going to go through, really the bulk of the training is going to be this next part where we want to give you some best practices that are going to position you really well to do loans well in the future and going forward. We're going to go through a demo. We've got Caroline Castanolo on the call. You guys all know her. She's fantastic. So she's going to go through and share her screen and go through some things that I think will be helpful visuals for us to learn some of those concepts or to get sharper in some of those concepts. And then we want to just provide a little bit of insight and suggestions on how we go through and do things in the right way going forward. And then we'll have a Q&A at the end. If you have a question, just type it in the Q&A bubble there, and then we'll answer questions that way when we get to the end of the call. So in terms of a Primerica update, You guys have seen this slide in the past. Lots of great news to share. We have a ton of reps that are joining. We're up over 918 licensed MLOs now across the country, and that's across 12 states that are open and operating. 4 more have been announced. We're adding a lot of reps every single month. We've got 247 of them right now that are in doing their licensing, and an additional 283 that have finished the 20 hours and are scheduled to take their exam. And it's just been really exciting to see. You can see on the right-hand side, we continue to have a lot of production, a lot of success, a lot of clients that have been helped, and as a result, paying a lot of compensation out to the field. So you know, it's effectively giving reps at Primerica an opportunity to build your business, have some success, increase your income, and help thousands of clients. As you can see, so far year to date, 1,712 closed loans. Those are all real clients, real households that have been helped in a material way, which has been very, very exciting. This is a cool slide just because we're up to 10 reps now that have earned over 100,000. They're our top earners in mortgage. This is kind of since the inception of the mortgage program. Many of these have done this in a matter of time that's shorter than even a 12-month time period. But you can see we've got Bernie and Ken are close to hitting the $200,000 mark in earned mortgage compensation. And you know, there are success stories all over the place with every single one of these reps if we had more time to spend on it. But congratulations to all of these trailblazers who have really figured out some great things and having a lot of success. And I wanted to highlight that and the possibility and the potential on what mortgage can do to help you build your business. We are, you know, we've heard about Decade of Dominance. I have not, unfortunately, I have not been with Primerica for 20 years. I wish I had been. But I joined about a year and a half ago, and one of the very first things that I heard was a speech from Glenn Williams kicking off the Decade of Dominance. I joined right at the end of 2019, and man, it's a little bit biased, of course, because I'm in mortgage, but the message around the Decade of Dominance and what Primerica is going to accomplish in the next 10 years to disrupt the financial industry, to accomplish great things. And you know, mortgage is such an important part of anybody, you know, of a homeowner's financial picture, or even their goal if they're not a homeowner yet. That it would be hard for us to accomplish everything that we want to in the Decade of Dominance without mortgage being a very critical part of that game plan. So it's exciting that we have that here and that you all are a part of that and blazing the trail. So the challenges I wanted to offer today while we've got you on the call is if you're on the sidelines, if you've worked so hard and you've gotten your mortgage license and you either did some loans and then it was kind of hard and you stopped for a while, or you've never gotten around to doing one, it's uncomfortable, you're not quite sure how to progress, you've been too busy, whatever the reason is, I want to challenge you to get in the game, to you know, get off of the sidelines, jump in there. We have a lot of ways to support you. We want to support you. Reach out to us, reach out to your account executive. We want to help you get in the game. Now is the time to do it. And we can help you get there. And if you're already in the game and doing great things, and there's many of you that are, we have almost 500 reps right now that are actively doing loans within the recent couple of months. If you're there already, just use this time to elevate your game, whether it's getting more efficient so that you spend less time on an individual loan, or whether you're figuring out how to find more clients to talk to and what your presentation looks like there, or sharpening your skills on how to price out a loan and talk to clients. Whatever it is, just work on elevating your game so that you can take that even further. We're planning some big things in June and July, so be on the lookout for some announcements early next week as we come out of the Memorial Day weekend. We're going to have a lot of fun in June and July in getting better, honing our skills, and also having some fun ways that we can earn some prizes and that sort of thing to as we elevate those skills and as we have further success in June, July. So be on the lookout for some fun Primerica mortgage promotions there. All right, so that's kind of an update on Primerica Mortgage. Now let's get to the heart of why we're on our call today. I'm going to turn some time over to Bob Van Acker to take us through some of the changes that are happening on the Rocket Mortgage side. Thank you, Bob.
Thank you, Nate. Obviously, it's a very exciting time in the mortgage industry. Rates are still super, super low. There's a lot of borrowers that can still qualify for a very good benefit with rate and term refinances. We're seeing a lot of cash out refinances as well. And obviously purchase season is right around the corner. We've made some big changes here over the last couple of weeks. and changes that will happen next week as well to really simplify the process and make for a better client experience as well. One of the changes that went live last week is that now during the registration process, you'll have improved visibility on QM, so qualified mortgage. So right when you register the loan, you'll be able to see whether that loan passes QM or not, and you'll be able to get the right disclosures out up front. So that way it provides a better client experience because the rate that you're going to send the disclosures on, that's what they're actually going to be able to close with, which is awesome. Now, June 1st, there's a big change coming. So this is a change that has been set in stone with the industry for a while, and we're making this a concrete change moving forward. So June 1st, you're going to have to choose your compensation type up front. So you'll select the compensation type at the time of registration. You won't be able to change it later on in the process. So if you register your loan with lender paid comp, it'll have to stay lender paid comp until that loan closes. If the loan gets started with borrower paid comp, it'll have to start with borrower paid comp and it'll have to close with borrower paid comp. Just to go over a couple definitions here, we'll start off with lender paid. Nate, if we can go to the next slide. Cool. So lender paid compensation is the most common type of compensation. Typically, it's the cleanest as well up front, just because all the costs are rolled in. It's an easy to understand number as well. Lender paid comp essentially incorporates the broker compensation into the actual rate. And it's built in as a loan level price adjustment. So pricing and portals automatically include the lender paid comp into pricing. So it's super easy to do. Just price it out right in the portal and you'll have the correct pricing. It is possible to choose a higher interest rate and receive a closing cost credit, also called a lender credit or premium, right? You'll be able to use some of these premiums, these credits to offset some costs like closing costs, for example. So premium reduces the charge for origination fees first, and then it's applied to closing costs as they apply. So lender paid is the most common one. Next, we'll go over borrower paid. Nate, if we can switch slides. Cool, there we go. So borrower paid compensation, it's also referred to as client paid compensation in our portal. Borrower paid comp can be paid in a couple ways. Here they are. So number one is the client just brings that cash to closing. They just pay the borrower paid comp. Another one, you can use this on refinances, is you can use some of the loan, the proceeds of the loan to pay for that borrower paid comp. So you're rolling it in. And then last but not least, any credit that's not a lender credit or rate premium. So this is for your purchases, for example, you can use a seller or a realtor credit. Or if you have some title credits, you can use that towards the borrower paid comp as well. Just one big note for borrower paid compensation, premium cannot cover the broker compensation. So if you're on borrower paid and you have a rate that's kicking back some premium, it cannot be used to pay for the borrower paid compensation because it's paid by the borrower, right? Now that premium can be used to pay for other closing costs. So if a client chooses a rate with additional premium, they can actually use that premium to offset the closing costs. So it might not make a big difference depending on the loan in the overall cost to the borrower. It just can't go towards that broker compensation. One of the reasons why you'd use borrower paid comp is because QM fees are calculated differently. So some QM issues can be cured by going borrower paid versus going lender paid.
Awesome. Good stuff. Thank you very much, Bob. Appreciate that. And just to carry this on a little bit further, so the reason we wanted to lead with that and kind of go over a brief overview of what these two different compensation types are, is that we may have some situations, and we'll dive into those in more detail, to where you need to use borrower pay. So anyway, let's continue to go through here. So we've already gotten a question in the comment box already on this, but we're going to continue to register loans as lender paid. Unless you get to the QM screen and the system indicates that there is a QM problem or an issue that can't be cured with loan structuring, and then we're gonna show you what we want you to, the steps we want you to go through and take that may require you to go from lender paid to borrower paid. Missouri is the only exception to that, where in that state we want to continue to register all loans borrower paid. So in the event that we do convert that over to borrower paid, and again, we're going to show you an example of this in here just a moment. It's very important that if you're going borrower paid, that you enter only the state approved pricing. So when you're doing a lender paid loan, it's all built into the system. So it just happens automatically for you. There's no way to get it wrong with the pricing. When you go borrower paid, you're manually entering, again, we'll show you this in a demo in a second, you're manually entering what the price is for your state. And it's extremely important to make sure that you don't enter more than what that approved compensation is, and then you don't input less than what that approved compensation percentage is. And as a reminder, for most states, it's going to be 2.25% that you're entering in there. California, it's going to be 1.875. Iowa's got a bit of a special circumstance, so we're trying to go 100% as often as possible lender paid in Iowa. So we'll stick to that strategy. But if ever you run into the scenarios that we're looking at on this call today, and you need to look at a borrower paid scenario, we would just ask that you consult with your Primerica area mortgage sales manager, which is Danny Samet. All right, let's continue on. So some best practices to avoid QM issues. So like Bob talked about at the beginning, we've got some important changes that are happening here where we'll have to do loans a little bit differently than we've done in the past potentially. But what a great opportunity, like Mike mentioned, for us to just really hone in on some good quality best practices that we can do at the beginning of the loan process at registration. So once that loan is registered, if we've carefully considered all these different things and gotten real good at this, we're really going to cut down and avoid issues further on down the road with that particular loan. So number one, this is really no particular order. Number one is register the loan with Rocket Pro TPO on the same day that you take an application. And I'll just say by application, I would say if you've pulled credit for a customer, there's a couple more steps technically that you'd need to take to trip TRID. And you're familiar with TRID when you kind of went through and took your test. But you need, when you do an application in the Primerica portal and you pull somebody's credit, the clock starts ticking, and we've got 3 days to register this loan with Rocket Pro TPO. And so if you wait until the very last day to register that over there, you're not going to have much time. You're going to have half a day left, or maybe a day left at the most, to work through any potential QM issues that you might encounter when you get to that registration page. And so just please get in the best practice of, when you're taking that application, that you make it a top priority to do whatever you need to do, get with your area mortgage sales manager, get with your Quicken account executive, whatever you need to do, so that you can register as a best practice on the same day that you take that Primerica application. Then when you're in there in the system, if you do happen to run into something, then you've got a couple of days before that loan has to be officially registered. You can work with QM experts, you can work with your account executive, you can figure things out without the urgency of having to get that all figured out within a couple of hours. Another best practice would be to make sure that you're really being thoughtful about the value that you're choosing for the home that you put in there. We coach you on this in the training and everything, but we've got a great resource within Rocket Portal with a Property Hub. Then there's some other links within Property Hub, the examples you can use of Zillow, Trulia, and some other ones that are listed there. But we encourage you to make sure you're really using that, because we have as you all know, the prices of the housing market and the prices are just kind of all over the board. So in some cases, the comps haven't caught up. And so what we want to avoid as often as we can is getting everything set with the loan and then getting 3 weeks into it or 2 weeks into it, and appraisal comes back and it's substantially lower than what we had estimated, and which can potentially cause some issues with QM and some other things. And so as much as possible, be conservative with the value, take a look at what the values are out there, take a look at comps if you need to, and try to set the value as best you can at the beginning. And then the third bullet here is always remember to buy out the underwriting lender fee. We train on that as well at the beginning, but when you go in there, it's always that can be $999 that's negatively impacting that QM calculation. And so as we just want you in every single case to go in there and make sure you're selecting the box to buy out the underwriting fee. Underwriting fee or lender fee is kind of referred to both back and forth between the Primerica and the Rocket portals. Rate locks. Make sure you're giving yourself enough time on rate locks. So, you know, if you're at the beginning there and you see a rate that is the one that the customer wants, that's great. But consider, are they self-employed? How long is the appraisal potentially going to take on this? If it's in a rural area, we know appraisals are taking longer right now. So really important to give yourself plenty of time on the rate lock to get that loan done in that amount of time. And last but not least is pricing out the loan. We're going to dive into that here on this next slide. So as you go in, you're pricing out the loan. There are so many best practices here that I want you to take a look at. And I will say before I dive into this that we are going to, in the month of June, we're going to roll out a training that's very specific to pricing a loan. You know, we're not going to go into anything else other than pricing a loan. We'll get real specific with it, and look to that please be on the lookout for that. I think it'll be a really great training. But number one, first and foremost, always try to present the best options for the customer. So getting the very lowest rate on the rate sheet may not be in the best interest of the customer. So, and as you're talking through that with them, you can definitely decide that. But, you know, the amounts that a client would have to pay to get that very lowest rate, oftentimes, you know, I'll just say, you know, jump down a couple of bullet points here. So MLOs in the industry typically like to structure a loan for clients to bring as little money as possible to closing. And that's because that's what most clients want. Most clients would like to do their loan and bring as little money to closing as they possibly can. Choosing the very lowest rate on the rate sheet is often going to make that very difficult to accomplish. So we recommend that you start with the par rate, meaning the rate there in the middle where there's not too much premium, not too much discount point, you know, just right there in the middle, and then go from there and have that conversation with your client on what's going to be best for them. And we also recommend and urge you to use the Primerica pricing tool at the beginning. So as you're having this conversation, plug stuff into the pricing tool, kind of figure things out with the loan scenario. As you're starting into the application. Yes, once you get into the Rocket portal, you can end up choosing a slightly different price or something like that you did with the client. But the more that you can discuss that and kind of have QM in mind and start with the par rate and have that conversation with your client, knowing that the further down you go to get on that to try to grab that lowest possible rate is potentially opening up some QM issues for you later on. The more that you can do that at the beginning as you go through, the better, because it just feels better to a client once you get into register the loan and you're ending up with a rate that's the same as or very close to what you discussed at the beginning when you were in the Primerica application. Let's see, we've covered kind of some of this here. So just at the bottom here, so be sure that the customer is receiving a net tangible benefit for the cost. This is just a reminder for you as you go through. A good rule of thumb, we talk about this in our training as well, but a good rule of thumb is just if you look at, is the client going to recoup the additional cost of the loan in the next 36 months? And so what we're talking about there is that upfront cost. So what they're paying to get this loan right now, how long will it take that client once we've closed the loan to recoup the cost that they paid to get the loan? And so again, if you're going real low on that rate sheet, that you know, what they're paying for that rate would be included in that cost. But the simple way to look at that, and we'll cover this more in depth in the pricing training that we do, but the simple way to look at that is you're just looking at the difference in the upfront cost, that dollar amount, divided by the difference in payment that they're getting by doing this loan. And you know, how long will it take to make up? If the cost for the loan was $7,000, is it going to take 15 years to recoup the cost based on the difference in that payment, or is it going to take 12 months or 36 months? And kind of a good rule of thumb is that 36 months. If it's taking, for some customers, there are plenty of client scenarios where, man, they're planning on staying in their house for the next 25 years, really no chance, no plans to move somewhere else. You've gotten them a really great low rate. And maybe it takes them 6 or 7 years to recoup that cost. For them, that still might be the absolute best way to go, and they're going to save a lot more money long term. But unless they're sure of that, that 36 months is a pretty good rule of thumb. All right, so we've covered a few things here. This is really the meat and potatoes that I wanted to get to for this training. And you guys all know Caroline Castanolo. She's just a phenomenal partner over at Rocket Mortgage. And Caroline, I'm going to turn it over to you to take us from here and dive into some demonstrations.
Thank you very much, Nate, and hello, everybody. So what we have here are just the basic QM messages that you're going to see on the portal. And I have my portal queued up here that I'm going to do a couple demos here for you. Basically, when you're inputting your information, you're going to have the message here to run your QM test. That's whenever you have finished pricing out the loan in our portal. The last thing you do before running findings will run your QM test. Here we have an example of passing QM. If everything's good, you're going to get the green check mark. The loan passes the QM test. If you are failing QM, if the loan is failing QM, this is what that messaging will look like. Now, again, if you are in a state where where the high cost, the state high cost is an issue sometimes, you'll also see that message notification here if you're failing the state high cost or the federal high cost. So with that, Nate, I'm going to take over the screen and share my screen here. And there we go. Thank you very much. All right, so we're here in the Rocket Pro TPO portal under step 2, loan details. So here's where all the information starts being built. We have our pricing period, 45 days, buying out that lender fee. This is what Nate was talking about. You want to make sure that it says yes to buy out the lender fee. If it says no, if it came over no, just click yes. Our compensation type, I'm going to stay with lender paid for compensation. All right, I'm going to, yes, sir.
I think I might be seeing the wrong screen.
Okay.
Or at least,
oh, my fault.
There it is.
Okay. All right. Sorry, guys. I clicked I'm working at a different location and my screens are all backwards now.
Oh, you're good.
Okay.
I've got bad eyes. So at first I was like, man, everybody else gets it except for me. But then I realized, so thanks for starting over on that. Appreciate it.
No problem. I apologize. Okay. I'm sorry, guys. So we are in the Rocket Pro TPO portal. We're here under step 2. And here's where we're selecting our pricing period. Of course, I'm choosing 45 days. The buying out the lender fee, this is what Nate was talking about. If your loan is imported in and it says no here, just click on yes to make sure that you are buying out that lender fee. And for compensation type, I'm going to start off with lender paid comp. So I'm just going to scroll on down. Of course, I'm not going to go through this whole screen. You know how to complete this. And we're going to move on to step 3. So here's where we're pricing out the loan. There we go. So I'm just going to choose a lower rate here. Basically, I want to fail QM. So what I want to do is I'm going to choose a lower rate. Let's say about 2 3/8 we'll go with. We'll complete our anti-steering and we'll get fees.
And while that's loading, guys, of course, we don't ever want to intentionally fail QM, but for the purposes of this, we want to fail it to show you what it looks like.
Yep. So I'm going to run my QM test. And that's down here at the very bottom. Of course, here's our screen, our where we're building our loan estimate, basically. And here's that failure. So we want to take a look at this. We can click on this little caret and it has how to fix a QM test. So this is going to link us right into Pathfinder. I'm going to show you what that looks like and where you can find the information. So this is basically the understanding QM. This whole page is all about QM. If we start scrolling on down through, right here, fixing a failed test. Now you can come here, you can read all about it. It's walking you right through the process, just what we just did. And there are some suggestions on how to fix a QM failure. But I'm going to pop back over to the portal real quick. The portal also tells you by how much you're failing. So if I click on that caret under points and fees, and the same thing will happen under state high cost and federal high cost if we were failing there, you could click on those carets and you can see, hey, you need to reduce the fees by $1,900. So 1931 in this case. So what am I going to do? Well, I'm going to come back up here to my rates. And I was failing by 1931. I think I need to go to 2 5/8 here if my math is correct. So I switched to 2 5/8. Scrolling on down, running our findings. I'm sorry, not running our findings, running our QM. And now we have passed the QM test.
And Caroline, if I could just add there too. So it's a great example to just show where you could scroll, you can stay on the same screen, scroll to the top, take a look at and consider the types of rates that you're going for. So it really highlights that example where sometimes if you're trying to get that much lower rate than the amount, we were paying almost $7,000 to get that lower rate before, so it threw the cost out. Caroline did the math and went as low as she could go to pass, which is great. You may also want to consider, again, just the idea of going to that par weight rate. That might be the best thing for the client, because still at this one, the client's paying $4,500 essentially for the rate. But if you were to go to 2.99, the Rocket system doesn't show you how much you're passing by. We've asked them to take a look at that, and maybe we'll see that later on. So it only shows you if you fail. It kind of gives you the math. If you pass, it doesn't say, hey, congratulations, you're passing QM by $300 or something. But so what Caroline did cured QM, but there might just be a real small cushion there. And so again, if it's what's best for the client, maybe you move forward from there. But it would be I think smart to go through and say, I'd probably rather have a bit of a cushion here to where, maybe we want to pass QM by a couple $1,000 just in case, later on we have an appraisal issue, or who knows what else might happen down the price of the loan. So there's lots of things to consider here, but I think I just wanted to jump in there, Caroline, and point out it's a good example of how we haven't really done anything with switching compensation or anything. We're just looking at how rates can have such an impact on overall QM points and fees.
Thank you, Nate. Nate, would you like me to show the client paid option here?
Yes, I think that'd be so yeah, absolutely. That'd be great. So sometimes guys in this, let's just say in that particular case, you were doing exactly what Caroline talked about, and you weren't able to, you kind of got maybe down to that par rate. Sometimes with like a lower loan amount or different scenarios, it's going to be a little bit tighter on that pricing. And so you may get to that pricing that you just can't move away from. It's what's going to be best for the client, and you can't make it past QM. You're still off by a certain amount. The next step really would be to look at, okay, I haven't been able to fix this with changing the term, changing the rate, changing the pricing. So I'm going to try changing my compensation. So yeah, if you could show us kind of an example of what that would look like to go back and change from lender paid to borrower paid, that'd be great.
Absolutely. And before I go there, I just want to point this out too. If you are not able to make the loan work, you've tried everything, maybe you changed to client paid, still not working, you have this little link here to QM Rocket Connect. If you click on that link, you're going to bring up a Rocket Connect request. And you can see here, the Rocket Connect request comes over automatically with the failures, the tests that are failing. Now, what the QM team has asked for you to do is in your pricing screen, right here at the top, if you could copy and paste this information in, I'm just going to copy it, come back over to my Rocket Connect and just copy and paste that information in. That way they know what rate you were working at, what the pricing was, and then that way they can, really help you fix that QM issue. So I did want to bring that up. I apologize. I wanted to say that earlier, but again, if you're failing QM, you're not able to fix it on your own. You're just getting, you're getting stuck. No worries. Just do the Rocket Connect request, that goes directly over to the QM team, and somebody there will work on that for you and most likely reach out to you and hash it out how we're going to fix that for you. Okay, so back over to my step 2, and we're going to go to a client paid option. So here we're going to go client paid. You want to put in your percentage, 2.25%. Origination flat fee is always 0. And then you want to make sure you check this box that is the total compensation, $48.60 in this case. So always be sure you check that box, because that's telling us you're confirming that is the total compensation on this loan. Go ahead and save it. And we're going to go ahead and price it. I will go ahead and fail this one first. Oh, let's try 2.5, 2.25. Scrolling on down through, run our QM test. Oh, and it passed. I might not have something that will get me
Well,
to.
it's a good demonstration one way or the other, right? So
Yeah.
you know, it's every loan's going to be a little bit different, and so there is a difference between lender paid and borrower paid, as Bob went through earlier on. Okay, there you got it. Fail.
Yep. So you can see here we failed by $645. So I would think that rate right above that I had just chosen earlier, the 2.25, that would work.
Yeah, and so you still, even with borrower paid, once you've gone over there, you still got that same ability to go up there and you know, work through the pricing. But again, so you know, if you look at step 1's going to be do what you can with the pricing, then you don't have to do anything with compensation. But if you've exhausted that, you know, the structuring the loan in a way that'll let you pass QM, going over to borrower paid, sometimes just by virtue of flipping to borrower paid and coming back over and calculating QM, will be enough, like you know, like was demonstrated by Caroline. You go back in there, and that just doing that alone could be enough to cure the QM, and then you can go ahead and move on forward. And then if, of course, if it doesn't, Caroline showed you how to go through with Rocket Connect and get some advice back from QM experts. I looked up the turn times this morning, and right now on that type of Rocket Connect there at QM, it's showing 2 hours. So, you know, should be able to get a response real quick and be able to get their advice on other options that we can use to go through and cure QM.
Is there anything else that you'd like to see, Nate?
I think this is great. I appreciate it. I mean, if I'll go over to the slides and share mine again, and maybe we'll get to something where we got to toss it back over to you to show an example, but I think we covered this really well. I appreciate you going through this demonstration for us.
Absolutely. Let me go ahead and stop my share. It's all yours.
All right. Thank you. Thank you. Let me get the PowerPoint back up here, guys. So great demonstration. Just kind of get a visual of what this looks like from Caroline. And so I want to just go through a quick summary of we just talked about everything on here for the most part. So I want to go through a quick summary of what it was so that we have the right takeaways here. So if you're kind of envisioning, well, what are my steps? I'm going to register my loan lender paid. I'm going to go through, I'm going to calculate QM once I get to that slide and I've chosen my price. And more often than not, it's going to pass QM and I move forward and all is well. If I get a QM failure, Caroline demonstrated for us how you can click there and see how much you're failing by and why. So step 1 is going to be scroll to the top of that screen, start looking at your rate, your term, even the LTV, and look at the structure of the loan to figure out what adjustments could be made that's, again, in the best interest of the client and what you've been discussing to where you could get that loan to qualify QM, and then you can go ahead and move forward. And Caroline demonstrated right there, you can do that real time and make it happen. And so, and by using the nice thing is that QM calculator is built into that screen. So by, you can kind of play around with it the way that you need to. If that doesn't work and you've tried to structure the loan in different ways and can't do anything else, the next step would be to try flipping it to borrower paid compensation. It shows client paid in the Rocket system. So just like Caroline said, you go back to step 2, you go to that first portion there and change it from lender paid to borrower paid. And then you'll have to put the price in. And so just to emphasize what Caroline was showing you, lender paid just happens automatically. The price that's approved for the state is built in there. You don't have to manually enter that compensation percentage. In borrower paid, you do. So once you do that, those fields will come up. For most states, it's going to be 2.25%. Can't go higher than that, can't go lower than that. California 1.875, and then some unique circumstances in Iowa. Again, reach out to Danny if you ever get to that borrower paid. And then always put $0 in the flat fee. So you do that, then skip back over to that QM screen, go to the bottom, calculate QM, and you're going to see in many cases that just doing that was able to cure the QM, and you can move forward with the loan and progress as you planned to. If it doesn't, this would be the perfect time to go to the Rocket Connect option that Caroline demonstrated. Click on the link. It's beautiful because it pre-fills everything. You don't have a lot of typing to explain what's going on. It knows what's going on, so it pre-fills it. Copy that pricing, throw it in there to them, and send it over to QM experts, and then just be on the lookout within the next 2 hours or so, sometimes faster, sometimes a little slower. You'll get guidance from QM. They'll look at your loan and they'll give you some guidance. And the guidance may include some additional things you might not have seen in LTV or the price or the rate. It may be the compensation type. It may be where they're recommending that you should actually do lender paid or actually do borrower paid. And it could also come with some recommendations of AMROC fee reductions or a Rocket lender credit of up to $300. These are all things that especially for primary specific loans, our QM experts are looking at to get the loans to qualify and to pass QM. So all of these different recommendations may come from QM, so you can collaborate with them, email back and forth, do what you need to do to get this loan going in the right way. I mean, sometimes you're just failing QM by $400 or something. That's where some of these lender credits and reducing AMROC fees can cure that completely, and they'll do that for you, and we'll move on. So only after all of these, so there's all these steps we talked about, right? So we're going to be able to cure almost all of our loan situation, QM issues this way. But after you've exhausted all of these options, only at this point in time and you still haven't cured QM, would we resort to reducing broker compensation. So, and just to be real clear on that, so MLOs are not permitted to reduce compensation for any reason other than to cure QM failure. And it definitely needs to be on the advice from Rocket QM experts. So they've advised it, they've given the exact dollar amount that it needs to be reduced by, and we've already exhausted all of those other options prior to getting to that point. Another thing to be mindful of, and Rocket is doing this for us and have committed to keep an eye out on this, but it would be great for you to kind of pay attention to this as well, is if you have gotten to that point and you've gotten a recommendation from Rocket experts, you got to reduce at this point by $521. We've tried everything else at this point. It's important for you to also make sure that the AMROC fee reductions and the lender credit that were part of those previous steps to cure the loan are still in there and are counting. That way the amount that you end up having to reduce compensation to pass QM is after all of those things are added up and helping out with that price. So anyway, that's kind of a summary of what we just went over. Mike, with anything that you'd like to add or emphasize on any of these points?
I would. Thanks so much, Nate and Caroline. Great job talking through this. I've been trying to type along and to be helpful on some of the questions here, and we'll answer some more as we come to the Q&A piece of all of this. But I think this training is really important that we've gone through today. The reality is that up front, and let me just be really clear, there's a bunch of questions around this, just trying to clarify it. The process that we're going through in registration is you've picked lender paid, And that's how we're starting our loans and registration. That calculation, if you're failing, is being run in the background, and it is telling you, just as Caroline showed you, that you're failing. And that's when you go back and you look at the structure of the loan. Can we look at where we're picking the rate and the term? Can we take a look at that? Can we make an adjustment? Is the client willing to do 79% loan to value versus 80, or wherever the LLPA might be that might be causing us an issue? Could we consider a different term length for this loan as well? So you can go back in and modulate what that loan is to help pass it. If those steps aren't enough to pass it, then we're taking a look at changing it in the registration process from lender paid to borrower paid, not afterwards. Well, everything that we're describing is happening right during the registration process now. That's the change that we're really trying to drive home. You can look at that, and then if you flip it over to borrower paid, we're getting the exact same comp amount. That was one of the questions that was asked. Is the comp the same for lender and borrower paid to Primerica? The answer is yes. Yes, it is. As long as you're entering that right percentage. If our lender paid compensation in the state of Colorado is 2.25, which it is, you enter 2.25 on borrower paid compensation, everything's going to be the same from our compensation standpoint. What can happen is the calculations can be a little bit different. And there's sometimes, because there's double counting of discount points occasionally on lender paid compensation, that just by moving it to borrower paid, we can pass the test with little to no changes to that actual loan. And so these are some powerful tools that Quicken has programmed into the system that can help us. And they've also put on the table these dollars to help cure some of these when all these other things don't cure the loan. It is gracious of them as a partner, and this is one of the benefits from dealing with AMROC and an affiliated company of Quicken Loans, to reduce the AMROC fees to help get these loans through. Providing a $300 lender credit. And we just wanted to be transparent with you that that should be happening on the loans. In case a QM expert made a mistake, you should ask about those and make sure that those are all a part of it. There's been a lot here about, we talked about a number of states and some generalities. Texas is a little bit of a different kettle of fish because there's different rates on refinance and so forth. I'm probably going to suggest that we do a separate discussion with our Texas folks, Nate, and maybe Tony, yourself, and can get with, and maybe Caroline can get with the folks in the state of Texas and just talk about how we can do this in the state of Texas. Because I do know that there's different laws. There's a 2% rule there. We have 2.25 stated compensation, and we're continuing to evaluate what's the best approach to Texas. Everyone struggles to get this exactly the right way in Texas. It's not endemic to us. This is an industry-wide challenge. So those are some of the things that that I would add. We're not encouraging folks. One of the questions was, well, should I just go everything borrower paid to start with, because maybe that gives me more flexibility. It can create more flexibility in some ways, but there can also be some issues as well. As you heard from Bob, you can't use any of the loan premium to actually pay for broker compensation, which is a big part of the overall dollars that are involved in the fees and expenses of a loan. And so that can create its own set of challenges as well. What would happen is the principal amount could get reduced as a result of that. Net, the client doesn't wind up paying anymore, but they could wind up bringing more money to the closing. And so that's why we say, let's start with lender paid. There's some more flexibility with those lender premiums. And then if we have an issue that we can't quite solve there, then we look at converting that over to a borrower paid during the registration process and not after. And again, that's the change here. So anyhow, I clarified a few things. I answered a few questions during the course of that. And we can take a look at a few other questions. Nate, maybe you could just move to the summary slide here. Thank you very much. We're going to study this. We're all learning this together. These are recent changes. So we're going to be looking at this. We're going to be hearing feedback from you. We're going to be getting feedback from Quicken Loans, and we're going to come back and we're going to communicate with you probably in the next month or so about what we've seen, what we've learned, and then also before Quicken makes additional changes that may be coming down the road in a month or so, where we won't be able to even modify the amount of compensation that we have under borrower paid. So let's get really good about following the steps that we have here. They're really good steps. This is going to help our processes a lot. It is a change. There's no doubt about that. And, no one likes change. I certainly don't like changes in things I've already learned, especially when it took me a little while to learn it. But I think this will be a better process going forward for everybody involved. We appreciate you all joining here for sure. And this is a great time to be coming in. Glenn had a wonderful message on mortgage from the FAC, encouraging folks to increase their personal production, increase everything that they're doing, getting licensed and other things, because this is part of the future of our company. And this is something that serves families in a way that no other products can. Life fills a niche that no other product can, investments does, and mortgage does as well. So we're really excited about it. There's been some more questions popping in here. We're not going to be able to answer all these questions live with everyone today. We've tried to address most of them either in the chat or on the call. We can try to answer a few more here, but in all likelihood, if you have questions coming off of this meeting, please get with your area mortgage sales manager and let's follow up with you. We want to get to your questions, but we've had 500 people on this call and 30 odd questions that have come through, maybe 50 open versus closed. So we're not going to be able to get to all of them today, but we do want to be a resource to you and be a help to you for sure. So with that, Nate, maybe we can pause and take a look at the questions that remain in the questions box that we'll be able to get to today. I know we still won't be able to get to all of these.
Yeah, no, I think you said it really well, Mike. Every single question that I can see in here that you all are asking, and I see some raised hands too, I would honestly say every single one of them are very important to us and we want to get those answered for you. And the reality is, to Mike's point, with the over 500 people on the call, what we're probably going to need to do is just answer some of the ones that are coming through in patterns, and then really encourage you, to Mike's point about the feedback of the process, to really encourage you to reach out to your Quicken account executive, your Primerica area mortgage sales manager, for some follow-up on getting some answers to questions. And I will also go back through once the Zoom concludes and take a look at the questions that were asked, and we'll make sure that somebody reaches out to you proactively to dive in a little bit deeper and make sure that your question was answered. Mike, two quick ones that I saw that seem to come through in different ways. There are a lot of questions in there about maybe a little bit of confusion about us saying, after June 1st, you can't change compensation, but we're telling you can't. So the key there is registration. So after you've completely registered your loan, after June 1st, you won't be able to go back and forth between borrower paid compensation or lender paid compensation. So once registration is complete, that doesn't become an option anymore. So what we're talking about on this call is how to get really good at what we do leading up to that, so that we can solve for it before we're completed with registration. So for example, the demonstration that Caroline did, that's part of the registration process. The screen that you're going to come through, you're going to calculate QM. You're going to be able to, if you need to go to borrower paid during that point in time to get to make it happen, you can do that. So these are all done prior to registration, prior to it being complete. So hopefully that clarifies that question. Another question that's come up a little bit, and I want to make sure that we mention, is the QM calculator. So there is a built-in QM calculator into the registration process, as we demonstrated. There's also a QM calculator on Pathfinder. And so you can definitely go out to Pathfinder. If you wanted to just have a calculator handy and available to manually calculate what you're doing for a client, you could use that in conjunction with the Primerica pricing tool. Before you've even really gotten into the application, or you're midway through the application and you're trying to figure that out, you can get a better idea of what might happen with QM later on in that Rocket process. So the portals match. So the pricing portal, the Primerica portal, and the Rocket portal, those portals are going to match. The difference is the Rocket portal now has a QM the QM's going to calculate before it allow you to move forward. And we don't have that test yet on the Primerica application side. So using the calculator may be something, if you want to get more comfortable with what you're looking at, you can use that. So that's on in Pathfinder. Mike, did you see any other patterns or topics that you wanted to take?
I saw 3 or 4 other quick patterns that I'll just try to hit on as I looked at probably the next 10 or so questions. So one of them was really around the par rate. There was some question around what that actually is. So the par rate, if you look at it, and there's a couple of different definitions that you can use, but generally the par rate is the point at which a borrower neither has to pay a discount point to get the rate that they're at, nor are they receiving a discount point necessarily. And so that's really what you're looking at. So for example, if you're in a state that has 2 1/4, and depending upon what the LLPAs are, if you're finding a loan that's 103% of the par amount of the loan, if you're 103% on that, and we got 2.25 comp, and maybe there's some LLPAs that take it up to 103. Well, 103 would be the par rate for that loan. That's how you would look at it. A simple version of the par rate would be our compensation is 2.25 in most states. So if I see a loan that has a premium of 2.25, that's at par. But I tend to think a little bit more holistically about what some of the other LLPAs and pricing adjustments might be, and sort of take those into account when I'm thinking about par. And your AEs are, go ahead.
Oh, sorry, I didn't mean to interrupt you. Do you want Caroline to put that rate sheet up as a visual?
That would be fine. Caroline, you can bring that up and maybe just highlight that. But I would suggest getting with your AEs and talking about pricing. The AEs are amazing at a lot of different things, but pricing in particular, I'd encourage you to chat with them. While Caroline's bringing that up, she can maybe take a look down here and highlight. Caroline, your screen is a little bit small. I heard that a few times from folks. I don't know if there's a way to blow that up, but let me cover a couple of the others where you're looking to bring that up. One of the others was disclosures. How do the disclosures differ between lender and borrower paid? There's a nuance. Again, net, the dollars at the end of the day are exactly the same. Sometimes, though, they have to go against the principal amount in certain circumstances with borrower paid. But otherwise, if you add up all the dollars and cents, they all wind up adding up the same. So that's just something for you to keep in the back of your mind for sure. Caroline, do you want to point to a loan here where we were just talking about this par value and how that works?
Can you see my screen? Is everybody okay with my screen?
It looks good. Yeah, it looks
okay, good. Okay, so Mike, what I have here is a lender paid comp example on the board.
Perfect.
Okay.
So
So I
this
would
is
say
wonderful. This has got
looking in this
our
right.
compensation embedded in it already. So we're looking at a loan right there where you're pretty much that inflection point that Caroline is at. You've got a few dollars above and a few dollars below. That would be the par rate based just upon our compensation right there.
Yeah, it's if you look at that number at the far right hand side, the dollar amount, that's where it's helpful to kind of see where is par. And you could almost say that $45, $15, and $3.95, and you're just about par and kind of in that area there. But the true par rate there is 2.990, and and then you go up. If you go up to a higher rate, you're going to get all these credits back. You go down on the rate sheet, the client's going to be paying to get that lower rate. It's going to add cost. So anyway, that's that. It just helps with the visual. If there's some questions about that par rate, Mike, then that kind of goes along with what you're talking about.
That's perfect. And thank you, Caroline, and thank you, Nate. And as you all look at that, as I mentioned, you may understand that there are some other pricing adjustments or some other things or closing costs. You may go up where you're raising the rate a little bit, but you're having some more premium to work with to pay for some of those third-party fees. So you'll go through that. And as Nate said, we're going to do a training just on pricing because this really is really critical in mortgages and it can be complicated. So we'll go through and spend time on that. I do want to spend a moment on the payback period and the tangible benefit that Nate talked about as well for a moment. So just to be very, very clear on this, when we're looking at where we're picking at on the rate sheet, as you go up and down that rate card that Caroline just had, you're going to go down and you're in the rate and you're seeing that the client's bringing more dollars to closing, right? So where Caroline's looking right now, as I stare at my screen, my eyesight's not quite as good as it once was, but at that 2.5 rate, the client's bringing at least $5,800 to closing, all else being equal. There's going to be other fees as well, probably on top of that, but that $5,800, okay, let's just focus on that number for just a moment. You should look at what amount of savings they have on their P&I payment on a monthly or annual basis and how quickly they're going to pay back that differential. So if they're bringing an extra $5,000 to closing to buy the rate down to that 2.5%, how many years out or months out in time does the client need to pay? Their P&I payment's going to drop. You can actually see their payment right there is $853. And Caroline, if you go back to that 2.99 that we were looking at, it's $900. So the math is really simple. You subtract the 900 from the 825, you got whatever it was, or 853, you got the $50 there, or the $75 or whatever it is, and you divide that incremental amount of money they're bringing to closing there on their on that premium by that savings that they have. So it's like $5,000 divided by 75 or 100 or whatever the number is. That's the math. It's no more complicated than that when it comes to thinking about where you want to be on the payback period on the rate sheet. When you're talking about refinance loans and the payback periods, well, refinance loans, the payback period could be 3, 5, 7 years if you're adding all the closing costs together and thinking about that. So anyhow, I think there's good ways to think about all of these things, but that gives you at least a tool. And what Nate said about the calculator is also very valuable, because as you get better and, if you're just starting in this, the calculator is going to be maybe more complicated for you to run on your own, but your AE can talk you through that and can help you get good on it. So
Caroline, do you mind showing us that? Just if you still have Pathfinder somewhere, do you mind showing us how to get to the QM calculator? Oh, you got it.
I had brought it up. So let me just back that up for you. So basically in Pathfinder, I just typed in QM right there, QM. And right here is the test, the QM 3% and the Texas 2%. When you click on that, this will open up and you'll select whichever test you need to run, your loan amount, and you can input your fees. And then that will give you a pass or fail. Pretty much, I don't want to say exactly like what you see on the portal, but same idea. It's going to tell you by how much you're failing by.
Yeah, so if you're using the Primerica portal pricing tool, for example, and you put everything in there, you can see just the basic stuff, but you can also click on the link to expand the view and see all the list of fees. So what I would do is I would bring that up. I would use all that and calculate it in and get at least a close estimate of what I'd be looking at for QM, and if what the customer's wanting and what I'm thinking is going to be best for them is looking good for QM as well. You're gonna be in much better shape when you get to that registration part and you click on that button to calculate QM. You're gonna have a much better idea of what might come back. Thanks, Caroline.
You're welcome.
wonderful. So I think the only question we can wrap up with, there's another 30 odd, as we said, we're already over time here and we're sensitive to that and we're starting to see people peel off the call. So get with your area mortgage sales managers. If you still have questions on this, get with your AEs on some of the questions we flagged for them. You do have to fix this before you can register the loan. So this is not something, to Nate's point, sometimes, maybe we're not getting them registered on the first day, we're waiting until the second or third day. We can't do that anymore. We really have got to take that loan, get our disclosure signed at the kitchen table that we have, and then move this immediately over into Quicken's portal for registration, figure out if we have an issue there, and then follow the steps that we've talked about. And you don't want to do that in the 11th hour because you're not going to get anybody to fix that loan with you. So do it in advance, get the QM experts involved as necessary, and we'll get this over here. But I would encourage everyone highly to get these loans registered. Once you've pulled credit, get to the end of the TRID application, get them submitted into Quicken and get this resolved, because you are not going to be able to register that loan through Quicken if it is failing QM. You must pass QM to get it registered.
Yeah. Cool.
Wonderful.
Thanks a lot, Mike. Thanks everybody for your time today. It's great talking with you. And again, don't hesitate to reach out for other questions. We can have conversations outside of this call. This is going to be great. Let's have a great June, July, and a great summer in mortgages. Have a happy Memorial Day. Bye-bye.
Take care, everyone.